Welcome to DeFi by Design, where we talk all things blockchain and cryptocurrency while striving to educate, empower, and enrich.
It's your boy Andy, and welcome back to the DeFi Slate YouTube channel. Smash the like button on this video, that really helps us out, and sit back and enjoy the content. Thank you very much. What's going on, y'all? Welcome to episode 62 of the DeFi by Design podcast, hosted with your boy Andy and Rob. And today is another day in DeFi, which I've aged 300 years in the last 1.5 years, but at least my crypto wallet looks better than it did 2 years ago, right? I'm joking. But here we are, having a good time, learning about DeFi again, and primitives that are going to keep popping up as we grow the overall ecosystem. I remember when we first started, there was hardly any places to get like yield on stables that were, that didn't have such high fluctuations. Now we've come such a long way to we see all sorts of locking mechanisms and bribes and votings and fixed rates and all sorts of stuff. So today we're going to get into some of the nitty gritty of the evolution of yields in DeFi, kind of what's to come in terms of DeFi primitives, specifically with regards to fixed rates and how we can lock in fixed rates on not just stables, but also on ETH and wrap Bitcoin and other assets as well. So you can kind of turn risk assets into basically guaranteed yield creation or generation of yield assets, which really is going to be a big turning point for a lot of institutions. So here today with Teddy as well from Notional Finance. He's been building in the fixed rate world for some time. But before we hop over there, let's see what Rob's up to.
Yep. What's going on, guys? Super stoked to have Teddy on the pod today. We've covered quite a bit of yield farming across different chains and not too much on fixed rates, which is where Notional Finance is building and making their mark. Stable coins, other Bitcoin or ETH, fixed rates are a primitive that exists in traditional finance. And unlocking them on decentralized finance is going to have quite a few breakout points, we anticipate. So we'll talk about how Notional kind of achieves these rates and the new products that are coming out on Notional's end, some of their collaborations across the different across Web3 and their different partnerships. So I'll go ahead and pass it over to Teddy and let him introduce himself.
Hey, everybody. Andy and Rob, thanks for having me on. I'm excited to be here. As you guys have said, I'm Teddy. I'm the co-founder of Notional, and Notional is a fixed rate lending and borrowing protocol on Ethereum. We've been around for about 2 years now. That's 2 years of hard work, and just about 3 months ago, we launched Notional V2 and our protocol token, which has been awesome and took like a lot of time and effort to get there. But today we have something like $460 million in TVL. We've done like $260 million of actual lending and borrowing. And just like things are really kind of taking off for us and exploding in a lot of different directions, which has been, really exciting. And I look forward to, sharing some of that stuff with you guys today.
Super. Yeah. Kind of, I guess, getting started with stable coins and how they fit into the ecosystem over at Notional. I saw an article the other day about USDC minting natively on Avalanche. And that's super cool that they're kind of going cross chain, but a statistic in there that I thought was like really, really captivating was that there was $40 billion in stable coins issued. And that starts to compete with like the size of like national banks and really up there in terms of some of the largest institutions in assets under management. I'm curious how you kind of see the stablecoin lending and borrowing environment kind of evolving, and then what types of interactions something like Notional Finance might have as a protocol with a traditional bank or a traditional institution that's kind of managing fixed rates in more so the traditional world.
Yeah, man, that's a great question. So I think so I'll start by saying that, fixed rates are super new in DeFi. But if you look like in like traditional finance, I mean, they're everywhere, right? And it's like in general, when you like have a savings account or whatever you have with your bank, they're going to tell you what rate you're going to earn, and you can pretty well rely on that rate not changing, right? And generally they do that because people just prefer to know what rate they're going to earn. And I think it's something that you're also seeing in crypto. So it's like, I think there's been more of a push by people like Coinbase and even Compound to offer a product that's like gives more mainstream people like the DeFi yields, right? Coinbase wanted to launch the Coinbase Earn product. Circle launched a fixed rate product for institutions. And so I think that there's generally a recognition that mainstream users want fixed rates. And I think what's really interesting now is that these products that people are offering, I think the Coinbase Earn thing was like a 4% yield, right? 4% yield on your USDC. That's what they were going to give people. And right now on Notional, you can get like 9% fixed on your USDC. And so basically what I think that means is that if you're somebody who knows how to use DeFi and is relatively savvy, and you go direct to the source, which is Notional, you can get an extra 5 percentage points, right? Rather than going through something like, Coinbase or one of these centralized services that's going to make the interaction a lot easier for you. But what they're going to do is they're going to take a spread. And so I think that that's probably how it's going to shake out in the future. It's because I think if you're being honest, the number of people that are understand DeFi enough to know how to use it and really want to do it and are willing to jump through all those hoops, it's not most people, and so if those people will be able to go direct to the source and get paid more because of it. But I think that ultimately, I guess we see Notional as kind of being sort of like an institutional backend, right? Where the front end is going to be something like a Coinbase Earn, where they just handle all the hard, complicated, weird stuff of interacting with the blockchain and just give mainstream users something that they understand and that they want in an easy way, right? But again, if you know how to use the blockchain and you're willing to do it, it pays to do that, right? Because you can cut through the intermediary. Yeah,
and that I think encapsulates C DeFi into a fairly concise description. You got customers of centralized services that are willing to pay a spread for that convenience, where whether you're doesn't really matter who you're interacting with. It's using something like Notional in DeFi in the back end. But some people just aren't so familiar to take that step and log in with MetaMask, connect to the application themselves. So they'll pay Coinbase kind of like a convenience fee. But it does point to the improvements that decentralized finance is making over traditional finance, and I think it is like peer to peer. Opens up more market access, more capital efficiency. And this is what leads to potentially a greater risk-free rate, if you will, in DeFi compared to what we've seen in traditional finance.
Yeah, I think, and just to make a note here, I think the cool thing is so if you look at traditional finance and just so everybody knows, my personal background was in traditional finance. I was a interest rate swap trader at an investment bank, and so I think here's the interesting thing, right? So the risk-free rate in traditional finance is you can park your money at the Federal Reserve, right? And you can earn whatever their policy rate is on your excess cash. But the thing is, not everybody can do that, right? It's only very, very large financial institutions that have the ability to put their money with the Fed. So it's like a closed system, right? It's like a gated system, right? And then you, as you're just like some regular guy, you have to go interact with one of these banks, and they can, they're a financial intermediary. So they take a spread between what they can earn on the back end and what they're going to pay you. And the thing with DeFi is that like ultimately, like yes, these centralized services will exist to give you convenience, but you can always go direct to the source if you want to, right? And that is like fundamentally different.
Yeah. To make the analogy, centralized services like Coinbase that are providing you this nice front end and taking a spread are analogous to commercial banks and how they provide kind of that convenience layer to the Fed. In the traditional financial finance case, it's much more enforced. You can't interact directly with the Fed. You have to use a bank. Whereas in DeFi, you have the option. Do you want to take the more convenient route, or do you want to expose yourself to some higher rates and put a little bit more work in, but ultimately reap more of the reward?
Exactly. Yeah.
Yeah, and I think over time people will get there, but I think people are very satisfied with the 4% on Coinbase, the 8% on Nexo, the 10% on Crypto.com, and perhaps a business move could be to reach out to these teams and hopefully get on a call with them and offer them and explain to them what you have to offer at a product like Notional. Be like, hey, why don't you guys take some of that $8 trillion. No, I'm kidding. But take those hundreds of millions that you guys have deposited and just bring them on over here, right? So in essence, that's what they're doing. One slight concern that I have is something that Rob had brought up, which was this new kind of concept of fixed rates on non-stable assets, so ETH and wrapped Bitcoin and DeFi. Could you walk us through kind of how that is created? And I'd like to hit on some of my potential consequences or downfalls of offering fixed rates on volatile assets.
Yeah, sure, man. So I'll give you guys kind of a quick run through of like the little technical overview that I give everybody. So basically, the core concept in Notional is called Fcash. Fcash is like a zero coupon bond in that it is defined by a currency type and a maturity date. So June 1st, 2022, USDC is an Fcash token. Now that token is transferable and tradable. You can do whatever you want with it. And on June 1st, 2022, so on maturity, it can be redeemed for 1 USDC on Notional, right? So an Fcash token represents a given currency at a specific future date, right? And the way we enable lending and borrowing at fixed rates is by allowing people to trade between, USDC today and USDC on June 1st. Right? And the exchange rate at which you make that trade implies a fixed interest rate over that period of time. So, that's kind of in a nutshell, that's like the basics of how we do fixed rates. Now, as it applies to, more volatile assets like ETH and wrapped Bitcoin, you can also lend and borrow ETH and wrapped Bitcoin on Notional as well, right? And I think, to date, we have seen much more volume on stablecoins. So people are much, much more interested in lending and borrowing USDC and DAI. We've seen a little bit, we haven't seen nothing though. We've seen a little bit of volume on ETH and Bitcoin, but just much less. I think in general, people are more interested in borrowing ETH and Bitcoin than lending, just because I think like, the interest rates on ETH like aren't that high. So it's not super attractive to lend, just because there's just so much ETH everywhere in DeFi. I think it's kind of hard to get yield on your ETH.
And
the only way is like, staking, right? But that's just new emissions.
But like maybe this goes more it is a bit more relevant when ETH2 comes out and staking actually contributes to securing the network in running a validator node. That potentially has at least similar, if not more, interest potential than or you can maybe even boil it down to like value creation of the network more so than lending. Since in staking you're helping to secure the network, you're earning revenue from that. It might exceed some of the earning potential that is received through lending and borrowing.
Yeah, no, I think that's a good call. I mean, I think that we already sort of have that, right, with the like Lido and staked ETH, and I'm not super familiar with the ETH staking kind of ecosystem right now, but so we already sort of have that, right, where there's like a way for you to earn interest on your ETH, and I don't think it's made like a huge impact on the market because there's still a ton of if you look on like Compound or Aave, there's still a ton of ETH sitting there earning zero, right? And so people feel, for whatever reason that it's worth it to keep having it sit there. But I think that, as ETH2 comes online and it's like less risky to stake your ETH, right? I do think it's going to change things. By just having like this ultimate risk-free yield on capital, right? So I think that will change things. Yeah.
Yeah,
I don't know how. Yeah, nobody ever knows how. Like I think that's an important point to note.
Yeah. I think we'll see ETH2, roll out in phases, which we're already seeing on the development standpoint. Like they had kind of the merge of the beacon chain and the existing chain. We'll see it roll out in phases. And as far as I understand it, first it'll be proof of stake. We'll get some different native staking options to help secure the network. And then later on, maybe a year or two still further down the road, that's when we'll get sharding, the increase in scalability and the increase in throughput, lower the transactions and so on. But initially it might be more in terms of the securing the network through proof of stake and get value creation in that right. And we can touch, I guess, on some of the potential concerns of hitting fixed rates on volatile assets. Are there any that you guys are you have kind of top of mind at Notional that you're looking to mitigate through the protocol?
As in use cases for fixed rates on ETH and Bitcoin. Yeah.
So how are you? Someone can short. There's some different positions that people can take and strategies to take. And I guess the one concern that comes to mind, and then we can get into the use cases, is if the rate is backed up by kind of a volatile asset itself, it's not necessarily risk free. And I think that is a concern that people might point to. Maybe you can shed some light on how that is clarified or mitigated on Notional.
Yeah, sure thing, man. So basically, like, it's the asset is volatile, but the interest that you're paying or earning is denominated in the underlying. So like if you're lending ETH, you're getting ETH interest back in return. So like no matter what the ETH USD price does, like the amount of ETH you hold is always going to go up by like 2% a year or whatever the interest rate that you're lending at is. So in dollar terms, yeah, I mean, who knows where the value of your ETH is going to go. But it's all like denominated in the same currency, so it's not an issue from a risk standpoint.
Gotcha.
Yeah, if that makes any sense, yeah.
Yeah, it does. And if you don't mind muting.
Oh, sure.
And when someone is able to capture or have that level of guarantee on a rate that they know that they're getting, it opens up a world of opportunities that they can then go and do other things, either hedge and take risk off or potentially take more risk on, depending on their bias at any given time. And that kind of opens up many different use cases I think where you were headed.
Yeah, that's right. So I think like, something that you can do, right, is like, it's just if like let's say you're a borrower, right? And right now you can borrow ETH for up to 6 months at a fixed rate. And the borrowing rates are really low, right? So it's, I think, in the area of 1% to 2%. And so it's just sort of like, okay, well, that means that, what you can do is let's say you have some stables, and, right now you can lend your stables on Notional for 9% for 6 months. So you can go take your USDC, lend it at 9%, and then actually you can borrow Ether fixed on Notional against your loan. So you can lend it at 9%, which is already pretty good, right? And then you say, okay, well, actually, I'm going to borrow some ETH against that loan. So I'm not giving up any of my interest. I'm just going to borrow some ETH, and I'm going to do it at 2% annualized for 6 months. And then I know that I've got this ETH now, and I'm only paying 2% for the next 6 months. And so because I have that certainty on my costs, it allows you to plan, right? It just allows you to say okay, I know I can beat 2% return on this ETH over the next 6 months, right? I know I can do that. And so then you can just focus on putting your ETH into staked ETH, for example, where you can be really, really confident that you're going to earn more than the 2% you're paying on your loan, right? And that that's true, or you can be a lot more confident in that because you know that the rate you're paying isn't going to increase. So it just gives you the certainty, by giving you more certainty, it just opens up what you can do, I think. Is that's the basic idea. Yeah.
Definitely. Yeah. And in that strategy, you have to repay what you borrow in that currency. So someone that takes ETH, borrows it, and then, maybe sells it, then you're short ETH. But just borrowing ETH, you're able to take it at principal and then arbitrage the rate kind of across the multi-chain. Like you're saying, you can take it, you can go stake it in a validator node. And that might be a really lucrative but also popular use case is borrowing ETH and then going and staking it in a validator, to earn kind of that extra reward. And you're able to capture, the few percent arbitrage in between those rates, and at the same time you still keep your exposure, because you are borrowing it, but you're not going and selling it. You're actually continuing to maintain exposure as the asset increases.
Yeah, that's right. So I think it's really exciting. Yeah.
Yeah, that's awesome. And maybe you can talk more about the product that Notional launched recently, the partnership with Index, because I think that really does capture and hit on really all the areas that we've talked to up until this point.
Yeah, man. So I think, what I'll say is that, basically, so we launched in November. So we launched Notional V2 in November, and we the TVL of the platform just skyrocketed, right? And which was huge for us. And, there's a ton of stuff that we had to do immediately, just to make sure that everything kept working, because we were getting way more attention and interest than we ever got before. Right. And so there's a ton of backlog of stuff. But then, starting about a month ago, we sort of had capacity to do what we always wanted to do with Notional, which was to integrate it into other protocols and form partnerships and just build products that incorporate fixed rates. And so we have a number of these products that are going to be coming online this quarter, which I'm just really excited about. And one of them is what you just brought up, right? Which is this collaboration with Index Coop. So earlier, I think it was last week, so maybe last Thursday, they published the initial proposal on their governance forum. I don't know if you guys have show notes or something and want to link to it there, but they published this proposal for DeFi's first, it's like a bond ETF, right? So you can think of in traditional finance where, and probably nobody does this because I think, I take that back. The bond ETF market is really huge and it's trillions of dollars and whatever, but nobody in crypto probably does it because the yields are so low. But basically what this ETF does, this ETF within Index Coup, is it's going to be a way for people to buy into a fund that's going to lend fixed on notional and automatically roll over the loan on behalf of the user. So it gives the user totally passive exposure to the sort of like high fixed interest rates on notional. So it's going to be a stable yield that is reliably higher than what you're going to get on Compound or Aave. And it's going to be stable because like it's made up of fixed rate instruments on notional. So we're super excited about that and love to be working with Index Coup. They've been awesome so far, and just to be honest, it's just great working with other people in DeFi. And I think it's kind of the magic of what we're all doing here is that it's so easy to integrate and like form partnerships because all the code's open source, and like and that's just huge. Yeah.
Yeah, the composability is awesome, man, and it leads to so much collaboration across different teams, and how all of this is really a positive sum game, and we're creating more opportunities and again increasing scalability, increasing throughput and capital efficiency, and it leads to greater opportunities out there. The bond ETF that you mentioned, people don't use it in traditional finance. The degens that might be listening or might be accustomed to crypto, like you said, because the rates are so low. But DeFi fixes this. DeFi makes the yields higher, and now this product becomes an opportunity in crypto that is attractive to kind of the demographic that is trading stablecoins, staking, and earning some interest on their crypto.
Yeah, that's absolutely right. I think like that's it's what's so cool about DeFi is what we can like one that just the yields are higher, the interest rates are greater, but I think also what's so cool is like like this collaboration with Notional and Index, like it's obviously everything takes work, it takes a lot of work, but like it's so much easier than I can only imagine like what it must take to launch an ETF like in traditional finance. Like I'm sure it takes like 2 years, $20 million and like 100 people working on it, right? Like I think that is so cool about DeFi is that like like it's relatively frictionless, right? Like, and of course I'll say it again, it's like everything takes more work than you expect it to, but like it's just cool that like we can just like talk to this other team and decide to work together and just like produce a product that like without all these barriers to doing it, and that's I think what's from a builder's perspective and as an entrepreneur, I think that like that's awesome. That makes me like working here in crypto. Yeah.
The pace of innovation is so much accelerated in DeFi, and I think it goes to the philosophy to a certain extent and the openness. In DeFi we build bridges. In traditional finance they build barriers. Like it's much more open, and it leads to a rapid pace of innovation, kind of through open source code. It's many more iterations. I think over time, because people are using the same code, it's all relying on the same building blocks, which has its advantages and disadvantages, right? Advantages, people are always iterating on the same code, so they're using what works, and then they're replacing what doesn't. And then there's disadvantages when there is kind of a underlying issue. It permeates kind of throughout the entire industry, and we've seen how that kind of can manifest. But ultimately, through kind of like all of this cross-checking and through these different protocols using the same building blocks, people they discover those bugs and they're able to solve them and then continue building better, building greater things. And it's super cool to see, and we're kind of seeing it in many different areas. If you have any thoughts on there, and then switching gears a bit more to interest rate stuff.
Yeah, no, I think that's true. I think like I think the thing with bugs and sort of building stuff in DeFi is a really interesting. It's really interesting, I guess, because I think when we've encountered some of this stuff ourselves, like Notional's never been hacked, but we've been like we take security super seriously. I mean, we've been through multiple rounds of audits and we've had people identify vulnerabilities in our code and patch those as quickly as possible. But we've experienced this part of DeFi, and I think that I would love to say that that DeFi is only going to get safer and more secure, and that is true in the long run, for sure. But I do think that ultimately there's a lot more room to grow and innovate, and I think that more DeFi is going to stay risky for a while, in my opinion. It's just because you can't do new things. It's like what you were saying, Rob. People building off of each other's code and using the same code and stuff like that. Some of that's true. There is a lot of code sharing, but ultimately, if you want to do something new, you usually have to actually write new code. And every time somebody does something new, like Notional is it's a big code base and we wrote it all ourselves. It's not a fork of anything else, And anytime you do that, it's risk goes just hand in hand with innovation and doing something new, And I think that DeFi is going to continue doing new stuff, and so there's going to continue being this ongoing sort of security risk, which in one sense is going to keep DeFi interest rates high and keep rewards high because people are going to be scared of using DeFi stuff for a while, and not everybody, but a lot of people are going to be a little scared of using sort of newer DeFi stuff. But that's going to keep the returns high for the people who are willing to use it. And so I think it's just going to be, and it's obviously going to continue to be stressful for anybody that's innovating in DeFi. For a while. So it's not going to get boring anytime soon. Anyway.
That's I agree. I think kind of as maybe the high interest rates are because people are scared, and then there's not as much liquidity as there would be if everyone kind of understood hey, this is better than a bank, and all the liquidity floods, the interest rates go down. But I think that does point to it, and another reason why we might see, or I guess kind of the way that these you call them security risks, but they're almost like systemic bugs that are starting to come. They're showing themselves almost in more of a game theory sense than a system design flaw. The game theory design has gaps in it which lead to arbitrage opportunities. It's not so much that these underlying fundamentals that have bugs are really smart contract bugs. No, audits have gotten much more popular, and there's any base layer protocol like Uniswap, Curve, they've been audited through and through. And then there's other applications building on those protocols, but those security pitfalls have really been invalidated and audited to the extent that now most of the bugs, if you will, are arbitrage opportunities because they come more from this game theory type of flaw.
Yeah, I mean, I think what I'll say to that is definitely the smart contract bugs, they're still there. So those aren't completely gone for sure. But yeah, I mean, I think the longer that a system remains unchanged and sitting there, those bugs get worked out, right? And I think something like a compound, and I suppose compound's not a great example, so I'm not going to use that. I'll use Uniswap, right? Uniswap V2, it's been there for years. Pretty high confidence that it doesn't have any bugs. So yes, but and as the game theory thing, like, it's interesting because it's almost like, what is a bug? Is that a bug? It's sort of like it produces a bad outcome, but it's like not clear that it's really a bug, and it's like it's interesting because like it makes me think of like 2008, where it's like that's what that was. It's kind of like that was like a system design flaw, and it's like kind of similar to these like stuff that we have to deal with in DeFi now, like the sort of economic attacks, like kind of like you're talking about, which is it's just interesting.
Yeah, and kind of leveraging your experience as a interest rate swap trader back in the day. What's your take on the interest rate environment now? It's today's January 18th. A couple weeks ago, they announced they're going to start tapering these rates, or excuse me, they're going to start increasing the rates. What's your take on kind of the interest rate environment in the U.S.?
Yep. I think everybody seems to think the rates are going up, which, I think is necessary. So I think the Federal Reserve has to do something to maintain credibility. And I think what they really look at is like, they're looking at these like CPI prints, but they're also looking at inflation expectations. And they need to show people that like, they're actually going to stop this thing, right? Because inflation is, it's not entirely psychological, but there's like, what they're really worried about is like people just getting, having a mindset change. That's like, okay, now just inflation is a normal thing. Like that's what they're trying to not have happen, right? And so they need to act aggressively to make sure that people don't just like, feel like, okay, well, I guess this is just how things are now, and I think that they are very like, they're going to do that. And the necessary consequence of them doing that is rates will go higher, right? Like if rates aren't going higher, it means that people don't believe that they're serious about fighting inflation. And they have to make sure people believe that they're serious. So I think that like, at least in the short term, I think rates like have to go higher. Now, having said that, I think that they're also dealing with like the kind of the tension of like, how much higher can rates go before bad things start happening? Like for one, like, what like the interest expense of the U.S. government like just goes through the roof, and also just we've been in a low rate environment for like 15 years or something. And it's just impossible to know. It's impossible to know like what is lurking there under the surface. If rates go up 400 basis points, like who knows what would happen? Who knows, And so I think it's to be honest, they're kind of in between a rock and a hard place. I think rates are going to go up in the short term. But yeah, I mean, hopefully nothing bad happens. I mean, like, I think that like the best kind of outcome here is that, rates go up a couple percentage points and inflation subsides in the short term. And so the Fed isn't forced to move rates higher than that. Because I think if rates go up more than a few percentage points, like, I think some really bad things could happen. So I don't think they're gonna want to do that, and hopefully we're in a place where they're not forced to do that, because then I think we'd be in a position where we're choosing between a bad outcome and a really bad outcome. So like hopefully that doesn't happen. Yeah.
And some of those bad outcomes to asset prices going down, the housing market going down, and just kind of going into a recession, essentially. And they're kind of stuck between preventing that, which no one, of course, wants, these asset prices to decline extensively, and this psychological transition of inflation and it always being around and it just being a normal thing. Can you unpack? Why is this a thing that is this mindset so dangerous?
Yeah, I mean, I think to be honest, it's kind of like if inflation really starts to increase, to a point where people, you get this kind of mindset shift, it tears at the social fabric. And it's because ultimately it means that you can't plan for the future. It's part of what keeps society as a cohesive thing and what keeps people acting in a way that's pro-social and not violent and just generally nice, is sort of long-term stability, and it's if you have 7 to 10% of inflation, then how in the heck are you going to plan for your retirement? And so then you stop thinking of it forces you to shorten your time frame from I'm thinking down the road to how could you even think down the road when the value of your assets is decreasing by 10% a year. And so then you're forced to think short term, and everybody thinks short term, and then it's just pandemonium, and I think that's ultimately, and they can talk about the effect that has on business decision making and all that stuff, and that's very true, but it's also it's just the effect on societies is, I think, pretty dark. Yeah.
And it's concerning because we see a lot of inflation in DeFi. There's a lot of liquidity mining and tokens that are generating high APYs because they're printing new money and they're inflating their own currency and paying that out as an interest rate, and not really they're creating value though, because that is kind of what DeFi is doing. Is it's again capital efficiency, liquidity, and scalability. This technology is bringing new value to the ecosystem, and then they're choosing to kind of pay out that value in the form of new tokens. And I'm curious, kind of as the digital wave, as technology continues to evolve and improve people in not just DeFi but in the traditional world as well. Does inflation kind of need to keep up with this? And what I mean is if I'm not sure if you're too familiar with Andrew Wang and his whole thing, but automation is coming, right? So as automation starts to innovate people and the I guess hypothesis is that people are going to start doing things with their time other than working. They're going to do more creative tasks and through that create more value. So does inflation kind of need to keep up with this innovation, and keep putting new money into the environment so that the creative tasks can kind of use it effectively? Or is that somewhat of a fallacy and kind of we need to shorten our time frame, or I guess we need to lengthen our time frame so that we're still planning ahead and down the road we're not going to have capital that is 20, 30, 40% depreciated from where it is today.
Yeah, I mean, I think so I think I'd just make a distinction between money supply inflation and price inflation. So generally when people talk about inflation, they're talking about price inflation, right? But inflation on the money supply does not is a different thing, right? It's just that there's sort of more money around. That doesn't necessarily lead to prices going up. It can, right? And it's not crazy for it to do that, but it's also if there's new stuff to buy, then the price of the old stuff doesn't necessarily have to go up, right? Because there's just new things to buy. I think, and that's in a lot of ways, that's sort of like what economic growth is about, right? It's just like if it's just constantly creating new things to do for people, such that there's new things to buy. And I think that's kind of, maybe that's kind of a point you were hitting on, Robbie. Yeah,
absolutely. I think that frames the question really well. Is the inflation is people are investing it. They're using it for research and they're going and learning new things to build new products. And again, if we are using this money to build new things, it's not going to increase the price of the old things, the things that are antiquated. Those things are going to stay the same, and people are going to use the new money to create new things. And I guess that frames the question of, we're now increasing scalability. We're increasing the pace of innovation at which new things can be created. Does that necessitate a higher inflation rate, a higher monetary supply inflation rate to go create all these new things?
That's interesting. Yeah. I think so I think if you, first of all, if you just talk about crypto exclusively, right? So that's our own little crypto economy, right? You are absolutely seeing increases in the money supply, right? It's like all this money coming in, and there've been tons of headlines about it, right? The big venture, I suppose not so much anymore, but at least over the last 6 months or something, you would see these huge capital raises, venture funds raising all this money and all that. And that's effectively what that's doing, right? So it's not just the venture firms, it's also retail and everybody else coming in and buying tokens. They are inflating the money supply in crypto, right? And if nothing new was created, then I guess the price of everything would just go up. But that isn't true, right? There is new stuff being created all the time. And I think that, you can never perfectly match the two, right? Money coming in, new stuff being made. But I think in general, over time, it finds an equilibrium. And so I think that, that is what's happening, right? So it's people have sort of figured out that, all right, well, there's going to be all this new stuff going on, right? And so the money has come in to support that, right? Yeah.
Yeah, and I was playing devil's advocate a bit in the psychological, you can't have the mindset of inflation is normal. I was kind of toying with that idea. What if inflation kind of is normal and it's all for creating new value? Maybe the ideal situation is a trend where we're increasing the monetary supply, also at the same time being cognizant that we don't want to raise prices of consumer goods.
Right. No, absolutely, dude. That's to be honest, that is exactly what the Federal Reserve tries to do. Right. Because everybody wants, you don't want to put so much money in there that you just start pushing the price up of stuff. You try and expand the money supply as there are increased opportunities and increased things to do with that money. Right. That is the job of the Federal Reserve. Right. And so that is the ideal situation. And I think it's kind of just like a capitalist economic system. If you have a growing population, you constantly need new stuff to do. You just constantly need new places where you can put your money, new kinds of things being built, new jobs to be had. It's a constant need. And so, I think hopefully DeFi and all this other stuff has created a lot of wealth and has created, a lot of jobs already. And hopefully it can create more, and that's just good, solid economic growth. Right. Yeah.
Yeah. Yeah. And DeFi is providing this opportunity for all that economic growth. And yeah, man, we're super thankful for you and the Notional team contributing to all of this new financial infrastructure, and it's pushing us forward. It's evolving into a system with less flaws. We're not going to say there's no flaws, but we're getting to a more efficient system and one with less flaws. So yeah, super cool what you guys are doing over at Notional, and thanks for coming on the podcast today.
Yeah, thanks a lot for having me, man. Appreciate the time, and I think, by the way, I think that's the right attitude, right? It's like it's never going to be perfect, but this is a different financial system built for a whole new kind of economy, and hopefully it's going to be a little bit better than the last one.
Yeah, 100%. And before we hop off, it's notional.finance. Yeah?
That's right, notional.finance.
And awesome. And where can the audience find you on Twitter or Discord? How should people interact and get involved?
Yeah, for sure. So follow Notional. It's at Notional Finance, one word, obviously. And then hop in the Discord. So it's discord.notional.finance.
Perfect. Awesome. Cheers, man. Thanks.
All right. Thanks a lot. See you, Robbie.